get underway. Thank you for joining us. Look, I'd like to welcome you all to the webinar today, Investing Asset Classes. My name's Kelly O'Dwyer and I'm the Head of Client Experience and Family Office. To help us work through this today, I'm joined by Ross Sheerin, a financial advisor at Trustees Executors who has over 20 years experience in financial services and who holds an internationally recognised certified financial planning practitioner status. I'm also joined by Lucy McCarthy, a staff member at Trustees Executors, who has recently set off on her own investment journey and has a lot of questions for Ross. Different types of assets provide returns in different ways, with their own set of risks attached. By building a deeper understanding of what kind of asset classes exist and how each of these work, we can better manage our investment risk and returns and match them better to our financial goals. Before we get into the details, though, it's important that we start at the beginning. In this webinar, we'll look under the hood of the most common asset classes to help you better understand how investment and risk management work. By the end of the webinar, you should have gained a basic understanding of what is an asset, what investments lie within various asset classes, and answer some basic questions about why portfolios and many multi-sector funds are made up in the way they are. First of all, let me tell you a little bit about Trustees Executors. Trustees Executors is New Zealand's first and longest serving trustee company. We're a one-stop shop and offer a wide range of investment and estate planning advice. We're now located in over 5 major cities in New Zealand and supervise in excess of 195 billion in funds. As part of our effort to promote financial literacy and make financial knowledge more accessible, we're pleased to offer this webinar, which is part of an ongoing series on subjects of investment, wealth management, and estate planning. If you're interested, watch out for our next 2 topics, family trusts, wills, and estate planning. It's important at this point I also provide you with a disclaimer. The information that you're receiving today in the webinar is of general nature, and it's not meant to be personalised or regulated financial advice. If you have a question, please do use the Q&A section on the system. We'll address those as we go through, but we'll also have a question and answer session towards the end. So I'll now hand over to Lucy.
Thank you, Kelly. So Ross, can you tell me what an asset class is, or better still, first off, tell me what an asset is?
Well, that's a good start. Good question. The simplest way to describe an asset is something that feeds you. In other words, it's an investment that provides a return by way of some income or growth and value that can then be sold on in whole or in part for some money. By contrast, a liability is something that eats you. In other words, a liability is something that you owe to somebody else, or it needs input and time or money to maintain it, and or it's something that goes down in value over time. A car is a really good example of a liability, though I'm sure many people out there think quite the opposite. I know we're going to touch on the subject of houses a bit later on, and so we'll come back to these issues. I think it's important to get a grasp of assets and liabilities right from the start.
Mm-hmm. Okay, I've got that. So what are the assets that give income and growth?
Yeah, so assets are categorised into different classes that share the same sorts of characteristics. So starting off, the main asset classes are cash or cash equivalents, fixed income or fixed interest, property, shares, and another catch-all class commonly called alternative assets. You can see those up on the slide there. So investments in each of those asset classes tend to have differing risk and return characteristics. And in the following discussion, we'll have a look at each of these in turn and briefly describe what sort of assets they include and what sort of risks and returns you might expect. We'll also discuss why it's a good idea to own a range of investments across a mix of asset classes. So let's start with cash. I guess when most folk think of cash, they think of money in their wallet or in your bank accounts. That's correct, but cash or cash equivalents, when considered in an investment context, also includes cash at call at a bank, short-term deposits, or holdings in a fund that have similar assets. These funds can also hold things like short-term bills issued by the New Zealand Treasury. They're pretty difficult for retail investors to access because of the sums you need to invest in them. Non-currency cash assets are a form of debt security. In other words, you lend your money to somebody and they've got a debt back to you. Investors receive rent for their use in the form of interest. Securities are another term for an asset that's made into an investment by an institution or a business. I know that's a bit of jargon, but jargon's one of the things that investors need to come to grips with in order to understand more about investing. So, Lucy, if I use a bit of jargon, do feel free to pull me up along the way.
Okay, will do.
So cash assets are low-risk assets that are stable in value, and they're readily accessible, or that they become accessible within a short period of time, say a year. As an asset class, cash assets enjoy the lowest risk of loss of the full asset itself. But on the other hand, it's also an asset class most at risk of losing value due to inflation. That's by definition that the purchasing power of cash falls as prices rise. I've talked about risk a few times, and I think it's pretty important to have an understanding of what's meant by risk, particularly in the investment context. Put simply, investment risk is the uncertainty attaching to the return you receive on an investment. We can look at it in another couple of ways for the purposes of what we're talking about here. One of the ways is a possibility of a part or full loss of capital from what you invest. Another way is the degree that returns might vary from what's expected. Different asset classes have got different degrees of risk, which is one of the factors used in grouping them all into classes. So moving on, the next asset class we'll talk about is fixed interest. So like cash, fixed interest is also a debt investment, but like the IOU you see up on the screen there. This is where an investor lends their money to someone and is in turn paid a rent for its use. This rent's often called interest. Sometimes it's referred to as a coupon. Fixed interest asset class is called this because investments tend to have a fixed rate of interest. However, in reality, there's a number of different types of investments in this class, and some have a formula for resetting the interest rate over time, rather than having a fixed rate. So within the fixed interest class, we can find term deposits, mostly offered by banks and regulated deposit-taking institutions, personal and commercial loans, capital notes, preference shares of different sorts. Each of these can in turn have differing features, and they can be offered by a range of different institutions, such as the central government, local government funding agency, or directly by local authorities such as Auckland City Council or Christchurch City Council, or they can be offered by a company, Auckland Airport, for example, or Infratil. All of these organisations are called issuers. So the combination of features of a fixed interest asset, along with its issuer, will give rise to the risks that are specific to that investment. A key point to note is that fixed interest assets don't offer any growth, just the income. And so like cash, they are at risk of losing their spending power due to inflation over the period that you hold them. Many fixed interest assets, but not all, can be bought and sold or traded on a debt market. In New Zealand, the NZX, the operator of the main stock market, also operates a debt market called the NZDX. NZDX mostly trades assets issued by companies and some local and government authorities. Most countries will have more than one debt market. For example, for government bonds, the New Zealand government operates a market of its own. Some financial institutions also make a market for fixed interest assets, normally on a wholesale market and generally the banks. So in terms of ownership, you can own fixed interest assets directly by yourself or indirectly through a fund. Some fixed interest assets are only available to wholesale investors, which are typically funds or institutions. Some fixed interest assets are only rarely traded, for example, term deposits. Most other fixed assets are traded, however, and the prices can rise and fall. That can happen through changes in interest rates, changes in the creditworthiness of the issuer, and forces of supply and demand, for example.
So you're saying that the interest on fixed interest isn't always fixed, so you could lose money as the values go up and down?
Yes, it can be a bit confusing. You're right. The interest might not be fixed for its term, and because of the fact that they're traded, values can go up and down. So it's important owning a fixed interest security that you really understand the terms of the offer and be prepared to own it for its full term. It's much the same with investing into a fixed interest fund. You've got to understand the mix of assets the fund can and does own, and be prepared to remain invested for several years to minimise the chance of capital loss.
Okay, got that, thank you.
So moving on, New Zealand's favourite asset class is property. So what do we mean by property? It refers to the ownership of real estate, and that can include bare land, houses, commercial buildings, and special use properties such as farms, orchards, vineyards, forests, and even spaces like golf courses, just to name a few. So investment property, as opposed to an owner-occupied home, normally gives the investor income from rent. And the rent can be bid up over time, and in doing so, it should enhance the capital value of the property. Tangible assets like property are considered real in the sense you can see and touch them. And that gives the property an inherent value of its own. Property values do rise and fall, however, in line with economic conditions, changes in interest rates, and sheer supply and demand, for example. And it's not always easy to discern because not all property is the same. It can be altered over time to change its use, and it's actually not traded that often. Information on prices can also be hard to come by, which can disguise changes in value over time. Owning property usually comes with some associated costs as well, such as rates and insurance and maintenance and management inputs. The buildings involved with property are subject to wearing out or depreciation, and normally that'll require some sort of renovation over time at cost. Property really only becomes an investment where it generates an income, i.e. it feeds you. In contrast, residential homes should really just be regarded as a store of value rather than an investment asset. Remember, something that requires input on your part, like rates, insurance, is a liability, and it eats you. However, having said that, residential property does provide a return to you in the sense that it offers shelter that you'd otherwise have to pay for. Residential property is a popular and valid way to invest, although in general, commercial property does offer better returns over the long run compared with residential property. Commercial property leases are long run and bind the tenant in for the period of the lease. And over that term, there are normally arrangements to review the rent. In contrast, residential property agreements tend to be shorter term and provide plenty of ways that the tenant can exit in the short term. It is, however, much easier to buy and sell residential property. Access to finance through banks is generally easier, meaning there's a lower barrier to entry than for commercial property. Also, the cost of residential property is generally less than for most commercial properties. Both property sorts, however, have got certain laws and regulations that govern rental arrangements, and knowledge of that is very important. Property is also an asset you can own via a fund, which might be listed or unlisted, and each of those in turn have got their own particular characteristics. So just offer that sort of discussion just to illustrate how different assets within one asset class can in fact have quite differing risk and return profiles. However, overall, rental income from property, which should grow over time, should generate a total return greater than for bonds, for example, but with investment risk that's greater. However, property is generally a lower risk asset than shares, which is the next asset class we want to turn our minds to. So what's a share?
Sorry, Ross,
It is
before we
really-
move on,
Oh,
we've had a
sorry,
question
Kelly.
pop up.
Yes.
The question was, is now a good time to buy property? Did you want to address that one as we go through?
Yeah, why not? It depends on who you are and what you're really trying to achieve, I think. If you're buying it as a home for yourself, that comes with its own set of issues. You know, you might have a growing family and you need a bigger house. May have even been a marriage breakup, which requires sort of buying and selling. So there's lots of different personally driven issues that come into play. You might want to just get yourself rid of being subject to a tenant and the whims and possible short-term nature. So in that sense, any time could be a good time to buy. I think a lot of folk can be distracted by thinking about the current market state, and that tends to be more speculative thinking than long-run thinking. And property is a long-run asset. I think if you're going to buy it as an investment proposition, yeah, you do need to think a little bit more about the price you're going to pay, which will influence the sort of returns that you're likely to get. And obviously, owning a residential rental properties is a business, and you've got to look at the total picture of what sort of terms you might need to borrow on from the bank and all of those other regulatory issues that you need to meet along the way. In that sense, yeah, you might try to time the markets a little bit more. So I'm not sure if I've answered that listener's question.
Thank you. Great.
So turning to shares, essentially a share is ownership of part ownership of a company. So owning a share means you can enjoy part of the fortunes of that company. You often hear shares referred to as equities or stocks as well. So owning a share gives you access to the profits of the company. They could be paid through dividends or the growth in the value of the shares as the business grows. Or alternatively, if the business doesn't do well, your shares could become worth less. So the place where shares can be bought and sold is a share market. Once upon a time, that was a whole lot of people in a room sort of calling out to each other with the sorts of deals on offer, buyers and sellers. These days, that physical presence has been replaced by cyberspace. In other words, buying and selling is done electronically and at a distance. Most countries will have one or more share markets. The main one, as I mentioned earlier, is run by NZX, and there are another couple of secondary markets. The fact is, in fact, though, that most companies don't trade their shares on a share market, and this really applies to most small companies and maybe a relatively few very large companies. Purchase and sale of these shares, mainly between private parties, can take quite a while to transact and also cost a lot, as special business valuations and accounting are often involved. And generally, the public doesn't get to see these the values of those trades. So such shares are said to be illiquid when compared with the shares that are traded on a stock exchange. In other words, they're harder to sell compared with the trading that can take place on an exchange. The trading on most exchanges results in high volumes of trades and also far greater disclosure of information about the companies concerned, and the transaction prices are really quite visible to the public. So like fixed interest or property, shares can be owned either directly or by individuals or pulled through an investment fund. These can take several forms. The most common that you'd be aware of are portfolio investment entities or PI funds. There's also funds listed on a share market which can in turn have passive investment styles like index funds or be exchange traded funds or ETFs with more active investment styles. Just to add to the mix, that there's also companies that are listed on the share market that make it their business to in turn invest into listed or unlisted companies. Essentially, the ownership of a business offers the greatest potential for gain of any of the asset classes we've talked about so far. because you're owning a part of a business, but it also comes with the highest risk. An individual business can fail, leaving you with a part or maybe total loss of the capital that you've invested. For this reason, investors should hold a range of shares, preferably through a fund of some sort. The wider the spread of shares, the more likely it is you'll receive a market rate of return. While an individual company can fail and disappear, markets never do. They will endure over time. And that's a really key point to take on board when it comes to trying to preserve capital. Gains can also be made by buying and selling shares as values rise and fall. This offers the potential for significant returns, but it comes with just as big, if not bigger, the risk of losing money if you get it wrong. Trading any asset also comes with tax implications, and they really need to be understanding before you engage in it. So just moving on, last but not least, we come to alternative assets. So what are these? And essentially, as a class, it's a catch-all of a great number of different investments. So these can include physical or hard commodities, such as gold, silver, aluminium, oil, iron ore, copper, for example. These are all things that tend to be mined or extracted out of the ground. There's also soft commodities such as wheat, rice, soy, sugar, things that we eat and which tend to be grown. Assets can also include cryptocurrency, something you no doubt have heard quite a bit about, art or jewelry, stamp collections, antiques or livestock, just about anything that forms a store of value can be bought and sold. There's also other types of alternative assets that are really based on the assets we've talked about, all of the assets we've talked about, and which are called derivatives. So these are paper assets whose value really is based on the assets in which they're derived from. Just about all of the assets that we've talked about so far have got some sort of derivative instrument based on them. And there's really quite large wholesale markets that trade in derivatives. In general, alternative assets can be difficult to get information about, difficult to access for retail investors, and carry the highest degree of risk. In some areas, trading is not regulated, for example, cryptocurrency. They really lie in the domain of professional investors. So having talked about these asset classes, where does that get us to? With that information, what can we do about it? We can actually use it to help us understand and put together a portfolio of assets that spread across those asset classes. And we can do so in a way that will obtain a pattern of returns from that portfolio, such that we'll be happy to hold it for the longer term through ups and downs in the market. History shows us that different asset classes perform better at some times than the other asset classes. And it's pretty hard to predict from one period to another which asset class is going to do well. So for that reason, rather than speculating and trying to guess, investors should hold a mix of asset classes, which each in turn should hold a range of investments. And if we put it together in the right way, such a portfolio can provide a steadier pattern of returns over time than just holding one asset class. So how we invest our money in different asset classes or into a portfolio really depends mostly on our appetite for risk. Lower risk assets tend to be more stable, which makes them a good option maybe for preserving wealth in the short term, but lack growth. It's the moderate or high risk assets that are better for growing wealth in the longer term, but that growth potential comes with a higher risk of losing money in the short term due to an economic shock or just simple bad luck. So understanding your risk appetite is a really important step to developing your approach to investing and developing a portfolio in such a way that will allow you to remain invested in and basically sleep well at night through the ups and downs that markets are no doubt going to bring you.
Okay, so in summary, over the last few minutes, I've learned the main asset classes are assets, fixed interest, property, shares, and alternative assets. And I now know each asset class is made up of different assets that share relatively similar risk and return characteristics. Is that right?
Yeah, that's good. You've obviously been listening well. So they do have different characteristics. And so that allows investors to mix them in different ways to manage their risk and return over the medium term and the long term, then that'll help you stay invested through thick and thin, and give you the best chance of achieving your financial goals. So on the chart that's just put up there, you can see the relationship between the return and the expected risk that each of those asset classes offers. So cash and fixed interest on the left-hand side there are really forms of debt investment and provide income. And you recall that cash includes money or short-term bonds that really do offer lower returns but offer low risk. Fixed interest, next one up the scale, longer-term assets that offer steady and predictable income as well at a high level, but where the value can fluctuate, but only in a modest way.
So, excuse me, Ross, I've often heard about fixed income. Is that the same as fixed interest?
It is basically, yes. It's
Okay.
the terms are used interchangeably. Interest, of course, being a form of income.
Yeah.
So the other three asset classes, property, shares, and alternative assets, are really ownership assets where you own an asset directly or indirectly. And they offer growth as a result of that ownership. Property's got a foot in both camps in some ways. It offers some modest levels of growth, but most of its return should come by way of income if we're talking about commercial property. So just recapping, properties, owning real estate, where you receive those rent payments, offers a moderate degree of risk, but moderate growth over the long run. Owning a share is a unit of ownership in a company, and that gives the best prospect for growth and the potential for dividend income, but you're at greater risk of fluctuation in value over time. Alternative assets, which we've talked about, can be a variety of things with higher risk and quite often difficult to access for retail investors in a direct sense, and often using a fund is the only way that you can practically gain exposure to that. So having looked at that set of relationships, how can we relate that to actual investments? Just wondering, Lucy, if you invested into a KiwiSaver fund?
Yes, I am.
So has it got a mix of assets, just like we've been talking about?
Yes, it does, but it has others that you haven't talked about, like international and Australasian equities.
Sure, yeah. So your KiwiSaver fund will probably invest in the very same asset classes we've been talking about, but they can actually, those asset classes, be broken down further, often by country or region. For investors located in New Zealand, for example, that can mean fixed interest. Could be either issued in New Zealand or some other country overseas. Most countries issue bonds, as do their companies. The same can be said for shares. So we might own New Zealand shares or shares issued in Australia or other countries further afield. It could even be issued in something called emerging markets, which are countries that are developing and often grouped together in specific funds to represent different sort of risk that it offers. So the sort of asset classes and regions that a fund manager might put into a fund really all depend on what they think might work best together to manage risk. And it could also depend on what sort of areas they've got expertise in. I hope that what we've talked about to date will enable you to figure out what's under the bonnet of most of these multi-asset funds and why the asset manager might have put together the mix of asset classes they have. Hopefully as well, it should be able to allow you to judge if it's a fund that suits you, given what you're trying to achieve, growth or income, greater or lesser stability, whether you're investing for the shorter or longer term. The same applies to investors outside of KiwiSaver. Really the same issues apply to anyone that's putting together an investment portfolio. So I hope that's covered the ground in terms of asset classes. Are there any further questions, Kelly?
Oh, I think Lucy, did you have a question?
I do have another question. This has been a good overview. Thank you, Ross. So I've heard about the power of compound interest, so I'm keen to start investing now. But as someone who doesn't have a lot of spare income to invest, where do you suggest I start to look for investments that hold a range of asset classes like we've talked about today, but investing a smaller amount that I can build on?
Yeah, sure. For smaller sums, your answer probably lies in holding a fund of some sort. You're invested into KiwiSaver, but many investment funds have got an alter ego that's not a KiwiSaver fund. And so you can access those either directly from the issuer or through platforms. Or you might think about direct shares for example, if you want to learn more about, say, fixed interest assets or investing into a listed company, you can access that. So there's a range of platforms such as Sharesies, this Flint Wealth, and one or two more out there as well. Hatch is another one that comes to mind. And varyingly, they might give you access to either funds or direct shares, and you can invest relatively smaller amounts. And that can be a really good way of learning about the process of investing and its ups and downs. I think you just have to decide what it is you're looking to achieve, how much you're willing to invest. But yes, relating it all back to the power of compounding interest, younger person, one of the things they've got on their side is time. And I think it was Einstein that said that compounding interest is one of the most powerful forces in the universe. And so over time, you can really use compounding interest to grow your wealth.
Yeah, cool. Thank you. I'm excited to get started.
Thanks, Ross and Lucy. We do actually have another question. So following on from Lucy's question, how do you know what the best place asset is to invest into? For example, Sharesies. How do I know what company is best to invest in?
If you're going to invest in a particular company, you really need to do your homework. So any listed company, as I say, is traded on an exchange. So you can, if, for example, it's a New Zealand company, you can go to the NZX website and look under the company's trading, the NZX market for that, and find that company, and that'll give you a lot of price information and access to other information as well, such as the company's website. And either via the NZX or the company's own website, there'll be a lot of information, such as recent information to the market, which might include annual reports or half-yearly reports, other information that might have disclosed about trading updates. And so you really got to do your homework if you're going to drill down and invest in a particular company or a range of particular companies.
Great, thank you. As there's no further questions, we'll wrap up. Firstly, I'd like to thank you all for attending. Just a little reminder is the disclaimer again, this isn't personalised financial advice, this is general in nature. But I'll thank you, Ross and Lucy, for your time and your questions. I really appreciate it today. You know, in listening today, it occurs to me that while not everyone thinks they're investing, we all invest in some ways, whether it be through our home or KiwiSaver. And understanding how asset classes work gives us a better idea on how those investments work and what we expect to own and the returns we can expect. We hope after today that you feel more confident in your knowledge about investing. And if you'd like to watch the replay of the webcast, we'll make that available to you. We're also going to send you out a flyer or a Q&As based on what you've heard today. If you do have any further questions, please feel free to email Ross direct. And please feel free to join us for other websites and blogs, which we hope you'll find interesting. I'd encourage you all to continue to be curious and seek more knowledge about investing and planning, and I'm sure that will pay you back. Again, thank you for your time today, and we wish you all the best in the endeavours to grow your personal wealth. Thanks, guys.
Thanks, everyone.
Thank you.